Yes, the question is whether the Dow is overvalued here as it approaches 20,000.
There's no question stocks are not cheap. We're the S&P, which is of course a broader index, although the Dow is reaching that milestone, is selling for about 2021 times this year's operating earnings. Although I don't think that that's out of line given the interest rates are rising. I think we're going to get to 20. I think we're going to close over 20 before year end. But I think the path to 21,000 is going to be a little tougher. It's going to be show me the earnings, show me some of these good things that you are promising before I think we would really have another strong rally. And we went up on the Dow 10% in just a matter of 6 weeks, and I don't think we're going to repeat that shortly.
Well, what measures are you placing most confidence in? If you take a look at my Bloomberg, you'll see that the Dow, the relative strength index shows that it's at the highest in 20 years. That's chart 3505. If you look at the, Shiller Cape ratio, it's also extremely high. What are you looking at to measure?
Well, I'm looking at, I've written on the Shiller measure that why that might be overly bearish. I've published some work on that. I look at next year's earnings, which I believe are too optimistic. I have toned them down. But I think what has driven this rally is the expectation of significant corporate tax reform that could, in and of itself, boost S&P earnings by 10%. Some even think higher. So, that explains the movement of the Dow. If we get less regulation, if we get stronger infrastructure that sends the economy, that's almost like frosting on the cake that would send it higher. But I think the real move is taxation with the hope of less regulation, and that taxation legislation is moving rapidly through Congress at this particular point.
Jeremy, I understand, of course, that the bull market in stocks, has been driven further since, of course, Donald Trump was elected. Now, what we've also seen is that rotation out of the bond market. Jeffrey Gundlach said earlier this week that if a 10-year Treasury yield hits even 3% next year, the losses might actually spread beyond bonds and into stocks and real estate. What I'm wondering is if interest rates rise throughout the economy, could we actually see retail investors start to pull out of the stock market? And what would that do to the bull market?
Well, rising yields is definitely a headwind, and certainly the interest rate sensitive sectors, and we're talking about REITs in particular, some of the utilities are certainly going to be challenged in a rising interest rate scenario. But let's look at the big picture. I remember, I guess I'm old enough to remember when I thought 3% was unbelievably low for the Treasury yield. So in the big picture, I don't see 3% challenging stocks. The dividend-paying stocks are almost paying 3% with, with growth, inflation hedge possibilities that I think make them so attractive. So yes, from what we were used to, 3% looks high, but from an absolute standard, it is still, in my opinion, not a challenge for stocks. Nonetheless, I agree, those that are yield-based are certainly going to be, more challenged, and those, particularly the financials, of course, raising interest rates is a very big positive, and that the financials, I think, are almost half the rally we've had since Trump has been elected.
Yeah, you're absolutely right that, Treasury yields where they are now, even at 3%, still historically low. I wanted to ask you, though, about this comparison between the Dow and the Nikkei as well. I've got a chart here on my Bloomberg, which is showing, of course, both the Dow and the Nikkei 225 approaching the 20,000. The difference is that this has been a slow march higher from the 80s for the Dow, whereas the Nikkei has actually crossed that 20,000 many times, been there, done that, if you like. Does this tell you anything about US stocks versus global peers, or is it just an interesting pattern?
Well, Japan in and of itself is a very interesting story. As you know, looking back, the Nikkei reached 39,000 in 1989. So we're talking about almost 30 years ago. So it has been way above the 20,000, and to the 30,000 level. But as I tell people, at that particular level, it was selling for 90 times earnings. And that is totally unsustainable for any major market in the world. And that's why returns have certainly been poor from that astronomical level that we saw there. Both the Nikkei and the Dow and the S&P are on much firmer ground right now with respect to earnings. I mean, 20, 21 times earnings in a basically still very low interest rate environment coming out of an earnings recession, which now looks like it's certainly going to be better next year, I think is a certainly sustainable level. But, once you start from bubble levels, as we were 25 years ago in Japan, you're gonna suffer in your future stock returns.
So, Professor Siegel, I'm just going to pull up another chart on my Bloomberg relating to the financials you were just talking about. It's 332, and it shows how interest income is obviously going up and will go up more now since the Fed moved. Even LIBOR is increasing. But what is the net effect on the economy? Because obviously it's beneficial to financials. Is it going to hurt the consumer to offset that, though?
You mean the higher interest rate? Well, part of the higher interest, there's two parts to the financial rally. I mean, one part is higher interest rates, and one of the reasons is banks can't really charge less than zero on bank accounts, and when interest rates are zero on what they can invest, there's no margin there. Now, that's why once we get the rates rising, they're not going to raise the bank accounts anywhere near as fast, and that margin is increasing. I mean, that's a major factor. Of course, the second factor is an easing of Dodd-Frank rules and super tight regulation. I mean, the Justice Department has basically, certainly for the financials, extracted over $100 billion in penalties. We can talk about whether they were justified or not since the financial crisis. I mean, the hope that all that is easing and maybe we can get a return to profitability of financials instead of the attempt of the government to really almost turn them into public utilities that are totally regulated. So that's obviously the second factor. But no, higher interest rates, clearly are going to add to some of the interest expenses, but they're going to add to some of the savings accounts. And then again, from a big picture perspective, these are still very, very low from a historical standpoint.